go ahead and get started. Let's call this meeting to order. The police and fire.
This meeting is being recorded.
We do that?
Yeah. Thank you for recording this. Let's go ahead and get this meeting started. The Police and Fire Department Plan and Healthcare Trust meeting on April 2nd, 2020. Let's go ahead and do a roll call. Myself, Andrew Gardner, is here. Trustee Lonza, you present?
Yes.
Trustee Lee, present?
Yes.
Trustee Menon?
Present.
Trustee Muyo?
Here.
Trustee Santos?
Yes.
Trustee Sanzeri?
Here.
Trustee Votto?
Here.
All right, and we do have one empty seat, or trustee. Is Councilmember Foley present? She sounds like she's not on yet, but she usually does come a little bit later in the meeting. Councilman Harvey Lederman.
Wouldn't that be nice? Harvey Lederman's here. Thank you.
CEO Roberto Pena.
Here. Good morning, everyone.
And CIO Prabhu Palani.
Here. Good morning.
Good morning. And we also have staff, several staff members on the phone, on the call also. Thank you for being here. So what we're going to do right now, we're going to go ahead and jump to closed session. All the trustees and staff members who are participating in this closed session, you should have received an email from Ron yesterday. Just go ahead and click on that link and I'll take you right into the meeting. If you're calling in, there is a call number that you could use to call into closed session. We'll go ahead and wait once everybody gets there and then go ahead and get started in the closed session. So I want everybody go ahead and switch off.
Andrew, this is Muyo. Can I have either?
to open session. There is no reportable items from closed session at this time. Let's go ahead and jump to orders of the day. Just going to read a few things
This
out.
meeting is being recorded.
I'm just going to go ahead and read a few things out for the orders of the day, and then we'll get on to the rest of the agenda. Under the global financial circumstances posed by the coronavirus outbreak, there is an immediate need for the board and ORS staff to meet to consider current risk and opportunities impacting the retirement funds portfolios. Assuming that the boards define addressing the global economic impact on the fund's investments as an essential government function of the boards and their committees may proceed as follow. The board and the committees may notice special and regular meetings in compliance with Brown Act notice and agenda requirements. The meetings of the boards and committees may take place with any and all board members appearing telephonically. A quorum does not have to be located within the city limits. The boards and committees may design or designate an accessible offices of Office of Retirement Services as a single location from which members of the public may participate in the meeting. The ORS premises are not city officials' offices subject to the pending city shutdown. One or more ORS employee may be designated to physically be present at the ORS office in order to facilitate the public participation in the meeting, subject to the relevant social distance requirements also imposed by the civil and health officials. Those employees will be exempt from the shelter-in-place order. Like our last emergency board meeting that we had a few weeks ago, all votes that we are going to be conducted will be done by roll call. And I'm just going to go down the list, starting with Drew Lanza. I will be putting Howard Lee right in the middle since he's a newer trustee. And we'll just do roll call that way for all votes. During presentations, please just take notes of any questions or comments that you want to make until the end of the presentation. And when it's time for Q&A, I'll just go down the roster just like we do for votes and see if anybody wants to make comments or has any questions to have. We are going to do our best to, run this smoothly. Last call we had was a conference call. We are trying Zoom now. The new technology is new for me. So bear with us if there's any some issues that might pop up. But so far it's been a great experience, and I hope everybody has a good one too. If there's any issues going forward, don't hesitate to reach out and ask one of the staff members, for help if needed. In regards to the Zoom, if you're not familiar with it, as you're facing the screen, there's just two buttons I want to point out to you. Bottom left, as you're facing your screen, there's the mute button. We're asking everybody to be on mute to avoid any background noise unless you're about to speak. And then also the video, you're not obligated to be on video. So if you want to be on video, you could certainly do so, or if you choose not to, there's a stop video button right next to the mute button. But that's up to you on how you want to be viewed on here. So at this time then, there is no sunshine that needs to be waived. And let's go ahead and jump to let's go ahead and jump to the consent calendar. Is there anything on the consent calendar that anybody wants to pull off? If there is none, then I'll entertain a motion.
Moved by Trustee Lanza.
Motion by Lanza, second.
I second it. This is Howard, trustee.
Okay. It's Howard, so second by Howard Lee. All in favor, or we need to do this, sorry, we need to do this roll call wise. Drew, how do you vote?
Aye.
Eswar?
Aye.
Nick? Nick, how do you vote? All right, we might have lost him. Santos. Trustee Santos. All right. Trustee Sinceri.
Aye.
Votto.
Aye.
And myself, aye. So that is, go ahead and 6 in favor, two are unable to vote. We might have dropped off on the call in accident. So that motion go ahead and passes. Go ahead and jump to investments. 2A, oral update from CIO of Retirement Service, Prabhu Palani.
Thank you, Mr. Chairman. I'll keep my comments brief. I will have some introductory remarks before 2B, just a heads up. But everyone knows that the board had a special meeting on March 18th and approved us going from about a 65-35 to a 70-30 mix. And I just want to give an update in terms of where we are in moving to the new mix. So we were able to actually get exposure to public equity right away using a combination of proxies and using the Russell Overlay Program. And I also wanted to give the board, prior to the March 18th board meeting, we also had some special IC meetings where we requested that we be able to use our 10% band within each asset class, especially for equities. So I just wanted to let the board know that we've been buying equities, and on March 12th, 16th, and 19th, the majority of it was on the 19th following the special board meeting on the 18th. And in general, we have been able to increase our equity exposure with the S&P just under 2,500. So March 12th, about 2,480, March 16th, about 2,500. The majority of it was March 19th, about 2,400. So I just thought the board will be interested in that. Now we have moved to the 70-30 mix on the public equity side, and there are some exceptions in terms of moving to the recommended mix. For example, as you know, absolute return is an illiquid asset class, so it's going to take us some time to trim that exposure. A lot of our managers there have gates, so it'll be several quarters before we actually get to the new revised lower allocation of 3%. Similarly, for fixed income, we continue to hold the allocation in short-term investment grade bonds as we look for opportunities in high yield and duration. So we will actually, I would like to bring a revised IPS for the board's consideration next month, which will basically state that we will be violating the 10% band, the discretion that staff has, especially when we move our strategic asset allocation quite drastically, because it will take us some time, especially with illiquid asset classes. So I will work with our consultant and counsel on the language and hope to bring something to the board at its May meeting. With that, Mr. Chairman, I'm happy to take questions before we move on to 2B.
All right. I will go ahead and open. Does anybody have any questions for Prabhu?
Can you hear me, Mr. Chair? I was
Yes.
taken off. Am I back?
Yes, you are.
Thank you.
All right. Anybody has any questions, go ahead and speak up. Otherwise, we'll jump to the next item. All right. So we'll go ahead and go to 2P, discussion and action on strategic asset allocation. Just a little background. You're probably wondering, why is this item back on the agenda? We just had this conversation two weeks ago. When we last met on our special meeting, there was part of the motion was for staff to come back with some higher risk portfolios in case, or higher risk options in case the market kept on dropping, or if the board wanted a little bit higher risk tolerance. And so staff and Makita work together to put together some options. So I'll go ahead and turn it over to Prabhu.
Thank you, Mr. Chairman. You just stole some of my thunder there. But again, just to reiterate what the chairman said, at its special board meeting on March 18th, the board wanted to see some higher risk options besides 70-30. And so our consultants and staff put together 4 other options, 2 for 75-25 and 2 options for 80-20. And the IC on March 24th narrowed it to 1 option for 75-25 and 1 for 80-20, which is now brought before the board. And with that, I will actually turn this over to Laura, followed by Eileen. So Laura is with our consultant, Makita, and Eileen is with our risk consultant, Veres, for those who are new. Thank you.
Great, good morning. Let me share my screen here. Here we go. Can everybody see the presentation?
No.
No. Let's see.
So we can see you, Laura, but we cannot see the screen.
Okay, let me try hitting that button again. I can see. Let's share screen. Let me try this one more time. Still not there? Maybe Linda, do you want to scroll through it since it doesn't seem that my screen sharing is working? Linda, are you there?
No, I am. I was on mute.
Okay. Would you mind if I just call out the slides scrolling through since you had the agenda open and it seems shareable?
Okay.
Perfect.
Can you
Thank
see it?
Yeah.
Yep.
Okay.
Thank you.
Great. So I'm not going to go through every slide since, as both your chair and Prabhu mentioned, we've been through sort of the groundwork for asset allocation several times. You can see from the introduction here, since the meeting on March 24th, we aim to incorporate feedback. We incorporated feedback from the board and the IC. As you know, markets have continued to be volatile during this time. Valuations still look inexpensive relative to the end of 2019. And so we wanted to bring back to you some riskier options in case you should want to adjust to a different profile in the future. So if you want to skip to page 6. This is the slide that begins the changes. You can see here that we've added a line at the bottom. One more slide, please, Linda. And we've added a line at the bottom on slide 6 that shows you the equity bond mix of each asset class or each asset allocation. So here we have the prior police and fire allocation on the far left, and we've called it prior because we know that your staff has already moved to what was another mix that we presented that you already adopted. So we've got the PNF prior, which was your old asset allocation, the one that was recently moved to just a couple weeks ago, which is current. And we show mixes B and C, which would increase the equity allocation in each of them. We then show the peer median allocation, and then a 60% global equity, 40% bond allocation on the far right. As we talked about the last time, you can't just necessarily add together growth as all equity and low beta other as all fixed income, because we do have some asset classes that are a bit more subjective in terms of where they fall. For example, emerging markets bonds and high yield bonds are under the growth asset class. However, we classify them for the equity bond mix as bonds, and then core real estate is listed under other, but we classify that for the equity bond mix under equity. So that's how we get those equity bond mix numbers at the bottom. In terms of the 20-year expected returns, you can see that they would be higher under the increasing equity scenarios. You've already moved from 7.4% 20-year expected return to 7.5%. which well exceeds your 6 3/4 actuarial assumed rate of return. And then if you look at mix B, we'd expect the 20-year average annual return to go to 7.8 and mix C to 8%. Those are both well in excess of the peer median expected return and the 60/40 expected return. And so your probability of achieving the actuarial assumed rate of return over the next 20 years increases with mixes B and C. I will go ahead and turn it over to Chris Theodore, who is on the line, just to go through a little bit of the other types of analysis we do, comparing where you are now to mixes B and C.
Thanks, Laura. We'll start this conversation on page 9, which starts with our MVO-based risk analysis. And these pages going forward just kind of drive home the point in quantifying kind of the age-old adage of no such thing as a free lunch. So while the plan is currently working off of mix A, P&S current, you'll see as you move to mixes B and C, the worst case returns and probability of experiencing negative returns do get a little bit worse as you take on more risk in the plan, but also your probability of achieving a 6.75% return increases as well. Then continuing through some of the standard Makita slides on page 10 and 11, we do touch base on scenario analysis, which highlight the same point, whereas a less risky plan will provide some more downside protection, whereas a riskier plan such as mixes B, C, will provide a little bit more upside participation. Then as we continue through, we also include our stress testing slides on page 12 and 13, highlighting the results of several isolated market movements using the current mix A as well as B and C. And then followed by that, we use our portfolio sensitivity analysis to highlight economic regime management, focusing on global macro factors for each of the portfolio options, and then followed by kind of the sausage making behind all the numbers in the appendix. I know the board has seen many of these pages before. These obviously are new risk portfolios, and happy to answer any questions that you might have on this analysis.
Yeah, I mean, I think the bottom line here is that if you were to move to mix B or C, you'd have a higher chance of a higher return over time. But that, of course, comes accompanied by increased risk in down market environments.
Are you guys ready to open up for questions, or do you have more during the more presentation you want to give?
We can either open it up for questions, or I know Prabhu has liked to turn things over to Viras for the risk discussion, and then maybe have a broader discussion. Does that make sense, Prabhu?
Yes, Mr. Chairman. If we can wait and have Eileen present as well, and then we can open it up for questions.
No, great idea. Let's do that.
Well, this is Eileen Neal. Can you hear me?
Yes, we can.
Great. Good morning, everyone. I'm going to also try and share my screen. I don't know what kind of luck I'll have, but can everybody see that?
Yes.
Okay, great.
Oh, Laura, pilot error.
I think I just got lucky. So starting on slide 2, I just wanted to frame some of the information that we're going to be going through in just a couple of brief observations. So as was mentioned, there's been a fair amount of discussion and analysis of varying asset mix alternatives to this point in prior meetings. So the mixes that are being considered today are, as Laura just mentioned, additional growth alternatives. And by allocating more to growth assets, there is a shift away from low beta assets and all of the alternatives that are being considered. In addition to just return and risk as defined by standard deviation, there are other metrics that you as a board focus on or should focus on in determining the appropriate asset allocation to move forward with. So as part of your governance in your investment policy statement, you have implemented varying risk operating zones in which different decisions can be made by different entities. And when in evaluating these mixes, we did evaluate them in the context of these operating zones and observed that, with the exception of one, all of the alternatives that you're considering today fall within those CIO risk operating zones. And Danny will talk more about that in a moment. Another metric that we tend to focus on in evaluating and comparing asset allocation alternatives is the risk-adjusted return, normally referred to as the Sharpe ratio. And as you'll see, the Sharpe ratios do decline modestly, and we'll explain why that is across these additional growth mixes. But I do have to emphasize that it's very modest and shouldn't actually dissuade you in terms of that metric of preferring one alternative versus another. These higher growth mixes do, as Laura indicated, have slightly higher standard deviations, and that really comes from an increased exposure to equity risk. So one of the metrics we look at to evaluate equity risk exposure is beta, and we'll talk a little bit about the equity beta of these alternatives, but they are all modestly higher than the current, or I guess what's now being referred to as the prior strategic asset allocation alternative. Another measure of risk, in addition to equity risk, is our interest rate sensitivity or duration risk. And so we do look at that for these portfolios. It's not really a factor for any of these portfolios, but again, we'll talk a little bit more about that in a moment. So we'd like to, we've had a number of questions in prior meetings about the risk operating zones and kind of how they're determined and driven. And so we thought we'd spend just a few minutes kind of talking about that process. And so I'd like to turn it over now to my colleague, Danny, to start on slide 3, which hopefully you all can see. And Danny Sullivan is on the line, I believe.
Yeah, thank you, Eileen. So hopefully everybody can hear me okay. Yeah, so prior to jumping into the results of the risk allocation study, we just wanted to provide a little background here on this whole discussion of risk limits. And not all board members have been privy to these discussions, so we're using this as a quick refresher. And we think that this can provide some useful and relevant data for today's discussion. So when Veris first came into this relationship, the board was asking questions about how much risk they were taking. And through the implementation of a risk system and through the reporting that we provide, we've been answering that question on a monthly basis. So the follow-up to that question is really, how much risk should the board be taking? Rather than how much are they taking, how much should the board be taking? And that's not a very easy question to answer, but we had a board offsite dedicated to diving into this specific issue of risk, and we worked with the board to create a framework that would uniquely answer this question for you. So this simple diagram here in this slide basically distills that framework down into its component parts. So first we start with portfolio volatility, and we identify the expected relationship between different levels of volatility and different expected drawdowns. And then we take a look at that information and we incorporate the board's risk tolerance to make a determination about the appropriate risk ranges and limits for the plan. And then lastly, these are all reinforcing. Lastly, we look at the potential impact on the board's financial condition and objectives. So this relationship here, this exhibit shows that interrelated dynamic of each of these component parts. And each additional piece of data that we collect further reinforces or modifies that viewpoint. And the process that we went through with the board really was iterative. So it was testing different scenarios and looking at different levels of volatility, and then incorporating that back into the viewpoint, and then further iterating and further revising. The other thing I would say is that while this calculation of volatility and drawdowns and even financial impact, those are all very quantitative in nature, this overall process and this overall relationship of honing in on exactly what's best and what's right for the plan is very much a qualitative process. So that's a brief overview of this whole thing. If we move on to the next slide, we can jump into kind of what this looked like in terms of rubber meeting the road here. And there's a lot going on in this slide, so let me just take a minute to walk through everything. So looking at this table, the first column defines the risk level a plan can consider adopting, ranging from 8% all the way up to 15%. And this is volatility, portfolio volatility. And so almost all pension plans in the US are going to fall somewhere on this table in terms of how much portfolio volatility they are going to adopt or accept, with the exception, of course, of plans who are very well funded or completely funded, and in which case they may be defeasing their liabilities to a greater extent. So this plan is being more explicit in terms of what risk level they take and what risk level they want to target and what that means in the context of the overall plan. So the remaining columns, once we go past portfolio volatility, are really the different measures or different ways that we can think about drawdowns. So there's not an industry standard for determining or defining drawdowns, but these are really the most common methods that we see. So just running through them really quick, the three different types of methods that we're looking at here, and I'll define the different percentiles in a second. But the first is VAR, or value at risk, right? And this calculates the maximum expected loss over a 1-year period, given a specified degree of confidence. And that's what the percent is, and I'll get to that in a second. The next is CVAR, or conditional value at risk. So this is also referred to as expected shortfall. It's all the same concept though. And this measures the expected loss if that VAR number is exceeded. And what it does is it basically takes the average of those tail observations. And then the last thing that we've included here is the average of the 3 worst historic scenarios. So this is a concept that we introduced, but basically what this does is we simulate the portfolio through several different historic drawdown periods, right? And then we take the average of those 3 worst periods to determine what the expected drawdown would be under these different risk levels. And we think that this is a very useful metric because we identify that models do not always predict what will happen in portfolio returns. So the next thing that we look at here are the confidence intervals. So we apply confidence intervals to both VAR and CVAR here. So a 95% indicates the level of confidence we have in that statement or value being true or being correct. So put more simply, 95% confidence interval suggests we would be right 95 out of 100 years, or we'd be right 19 out of 20 years, or conversely, we would expect to be wrong once out of every 20 years. And then a 99% confidence interval suggests we would be right 99 out of 100 years, or conversely, wrong once out of every 100. So the higher the confidence interval, the higher the expected drawdown, and then the more conservative your risk tolerance is. So we overlay risk tolerance on this table to provide insight into the considerations for the board. The bottom left of this table identifies the most aggressive risk tolerance, whereas the top right identifies the most conservative. And so the trade-off made here is really between which level or levels of volatility are appropriate, how the board chooses to define a drawdown, and what that impact is. And in the work that we did with the board and the offsite and subsequent meetings, we identified the limit for volatility, right? And this is the level to not be exceeded in the implemented portfolio, 12%. That was determined based on selecting a 25% drawdown as being the worst case scenario, and deciding that CVAR was how that would be measured. So you can just run your finger down through that chart and say 95% CVAR goes down to 12% risk. That's where we got our 25. So the coloring of the rows here in the table also help identify how volatility risk is being managed throughout the organization. So the red bar is where the board set its limit, and then the yellow bar identifies where once that level is approached or breached, then the investment committee is notified. And then that green zone is the chief investment officer's operating zone. So he's allowed to operate within that green zone. So the third step in this process is to understand how these drawdowns potentially impact the financial condition of the plan. And so if we move on to the next slide. So here again, these are very dense slides, these last couple of slides here. So let me just take a minute to walk through exactly what we're showing. So based on discussions with both Varus and Chiron, the board selected 3 metrics to focus on when monitoring risk impacts through time. They chose the actuarial funded ratio, city contributions, and interest cost. And so interest cost is not as widely discussed as actuarial funded ratio or contributions are. So the easiest way to think about this is if the pension plan was a mortgage on your house, right? This is basically the amount of interest you're paying in each period. So it doesn't actually pay down the principal, or it's not actually improving your funded status. This is just the amount you're paying in interest. So what Chiron did was they measured the impact of several different scenarios on the plan. So baseline, this is if the current assumptions are met over the next 10 years. And then we looked at drawdowns of 20, 25, 30, 35, and 40%, and measured their impact on these actuarial metrics that the board had set. So the assumption we make here is that these drawdowns occur this year, and then the plan achieves their assumed rate of return in the subsequent years. And all of this data looks over a 10-year period. So there's 2 tables here in this slide. The first table looks at the single worst year, or the single worst observation for each different metric over a 10-year period. And then the second table is a 10-year cumulative, and it looks at the end of the financial situation at the end of that 10-year period. So basically, what is our funded ratio expected to be? How much in total did we pay out in city contributions, and what was the total amount of interest cost paid? So looking at so just going to the first table here, the single year. So the board identified the limit of 25% drawdown. So this suggests, if you just go across this line, that the funded ratio would fall to 60%, right? And that city contributions would increase to 362 million. And then the table, there's a line separating the absolute values from the change in those values, and those changes are relative to what the baseline would be if we hit all of our assumptions. And you can see what those increases would be. The second table does the same thing, but just looks over the cumulative amount. So from here, we took that drawdown amount of 25%. We revisited the board's risk tolerance. We took into account the volatility levels and the drawdown amounts. And that's how we honed in on this overall risk limit and these risk operating ranges that we've been discussing. So hopefully this is helpful in terms of going over this framework and hopefully solidifying it in everybody's head so that we can have a discussion about if this is appropriate, because this may change in the future if the board decides to. But this is the overall framework that was used. So moving on to the next slide, now actually jumping into the results of the asset allocation or the risk allocation study that we're working on today. Here what you can see is different levels of volatility for each of these different mixes that are being considered, and we're overlaying that with the operating zones that we just discussed. So as a reminder, these zones or these operating zones are in place to manage volatility risk in the portfolio. So portfolio volatility is going to vary through time, and as the portfolio moves from one zone to another, it's an opportunity to notify the different parties, right? The board, the investment committee, and the CIO to have a discussion about these levels of volatility and make a determination about what should be done. Just because something breaches a zone does not necessarily mean that that's a bad thing. It means that it's an opportunity to have a discussion about what's going on in the portfolio. So we could go from green to yellow, and it would basically just mean that somebody needs to be notified about that breach. So we see marginal increases in risk going from P&F current to mix A, and more material increases in going to mixes B and C. And mix C has 200 basis points more volatility relative to the current mix and exceeds the CIO limit for volatility, whereas mix B is closer to exceeding that green zone. So we'll take a look at several other metrics. I'll move on to the next slide and ask Eileen to take this one.
Thanks, Danny. Again, can you all hear me? Yes?
Yes.
So as I mentioned earlier, risk-adjusted return is one of the metrics that we look at in terms of evaluating the relative attractiveness of one strategic asset allocation alternative versus another. And as you look across here, they're all very, very similar. In fact, they all round to 0.5 if we were to go to one digit, with the exception of the 60-40. So from this, based upon this metric, you would be indifferent from a risk-adjusted return perspective in terms of moving from your current, which the current now is what is called Mix A here since the implementation of a week ago or so, relative to the two other growth alternatives. On the next slide, I also mentioned earlier that equity risk is the primary driver of risk in any institutional portfolio, a retirement portfolio. And here we do see some distinction between the current mix and some of the other growth alternatives. And the way to think about this is if there's a 10% increase in equity beta, increase or decrease in equity beta, the new current mix, which is mix A, for that 10% increase would increase, say, 6.6%. Or if it was a 10% decline, would decline 6%. And conversely, the highest growth option with the highest equity beta relationship, mix C, would move 7.6% or have a return of 7.6% if the equities were to increase by 10% and conversely decline by that amount. So that is the distinction in terms of the impact on the portfolio from a return and risk perspective. The next slide is also focused on contribution to risk, if you will, from not just equities, but all of the main exposures, risk exposures in the portfolio. So the material we covered earlier in the Nikita presentation focused rightly so on capital allocation, and that is what you determine as a board is the capital that is allocated to the varying asset classes. However, this chart shows risk allocation. So for example, and we'll stay with mix A, that's roughly a 40% exposure to public equities. Whereas mix C, the 80-20 portfolio, has about a 51% exposure to public equities. So as you can see, the contribution to risk from those two exposures, roughly 40% and 51%, actually translate to a much higher contribution to risk from that exposure. It's over 80% in both cases. There are other contributors to risk, but as you can see, they're much muted. The second largest contributor is your credit risk exposure. So again, similar to equity beta, as you look across these mixes and you see the changes in contribution to risk from changing your exposures, that you again would be relatively indifferent between these mixes because the contribution to risk is very similar from that equity or increased equity exposure. And I'll let Danny make a couple comments about slide 10, which is yet another risk metric that is important to consider in determining whether or not to move to a various asset allocation alternative.
Thanks, Eileen. Yeah, so slide 10, looking at effective duration. So this helps us identify how sensitive the portfolio is to broad interest rate movements, right? And so in the case above, PNF current has a duration of 2.2 years. So this means if interest rates fell 1%, we'd expect the current portfolio to be up 2.2%. Conversely, if interest rates rose 1%, we'd expect the portfolio to be down 2.2%. And the same logic can be applied across all these mixes. The changes in duration are quite small. And we're looking at differences across all of these mixes of about 1 year. So nothing extremely large here. And I think it's important to put this in context of why we consider this. So we've discussed this before, but it's helpful to think of this of duration in the context of the plan's liabilities. And when you think about those, they have a duration of something around 15 years, right? And so we're not trying to create like a liability-driven investing strategy here in this asset allocation study. That's not part of the conversation, but it is important to identify that mismatch between the way that the portfolio is implemented and the risk of your liability stream are very different. So that's the only point I would make there. The duration between each of these asset mixes is very small. So moving on to slide 11, Eileen, did you want to take that?
Sure. So I think we've shown the scenario analysis before. We tried to make a little bit more distinctions between the bars, and there's also a table in the appendix if you prefer looking at a table. But the way to read this is the legend reads from left to right, and the bars are ordered similarly from top to bottom. So for example, the police and fire current is the orange bar. It's at the top of every one of these scenarios. 60-40 is the bottom bar in each of these scenarios. And across these, and these are historical, what we would call downside risk type of scenarios where we had sell-offs of varying degrees in largely equities. And the two primary periods to focus on where we do see distinction across these various mixes is the 2007-2009 subprime environment and the 2000 to 2003 tech crash and recession. And there are somewhat meaningful differences between the portfolio that you've now adopted, which would be the red striped bars, relative to two other higher growth alternatives. In the case of the 2000 to 2003 environment, we would expect the current portfolio to roughly decline about 23%, whereas or 25%. Whereas, say, the 80-20, the most aggressive portfolio, would sell off north of 30%. So while we don't want to have the downside drive ultimately our exposure, there is a lot of focus on downside risk given the existence of your risk limits. And so it is important to be cognizant of that downside in terms of evaluating these alternatives. We also created what-if scenarios, the worst being global equities selling off 20%. And again, there you do see the distinction. It's not as great, but clearly higher growth portfolios can offer higher growth, but during these down market environments, they do tend to perform worse. And of course, as you know, it's harder to work your way out of a hole when you get deeper because of the compounding of the negative return. And that's why we care about that. We did think it would be interesting for you to see the portfolios, how they would react in the current market environment. And Danny, why don't you finish us off with a couple comments about this slide?
Sure. Yeah. So this is the final slide we'll discuss here in our presentation, and then we'll open it back up. So we're still in the midst of this shock, right? So the final results of this scenario are still yet to be determined. And the magnitudes that we're seeing in terms of movements on a day-to-day basis are extremely large. So, you know, I guess the takeaway here is these results are subject to change. So we created two shocks here in the risk system. And what we did is we looked at drawdowns essentially going up through a certain period from March to the beginning of March through the period in which we delivered this report. And then the second way we looked at this was essentially a peak to trough, right? So the first shock, or that blue bar, is looking at that expected performance from March 1st through March 24th, right? So this includes a partial recovery in this result. And then that second shock, or the teal bar, looks at the expected performance of each of these different mixes, starting from February 21st, which is when we first started seeing markets reacting negatively to this news, through the close on 3/24. So this is the peak to trough. And this is, once this has taken its course and we know exactly how markets reacted to this, the peak to trough is a similar methodology to what we use in our other scenarios. So think about it in those terms. And so right now, if we were to use this peak to trough, right, we're experiencing this in real time, but this is going to be discussed alongside the GFC and the tech bubble. We've seen drawdowns to that magnitude. We have seen quick recoveries from that, as you can see here, but to put it into context, this has been a very large shock to portfolios. So with that, I'll put it back to Eileen if you had anything else you wanted to say.
No, I think we're interested in hearing your questions, and the meeting is yours, Mr. Chair and Prabhu.
Thank you very much, Eileen, Danny, Laura, for the presentations. Prabhu, do you have any further comments, or you want to touch base on the other item on the private market side?
Yeah, thank you, Mr. Chairman. So just the couple of comments, but before that, the other item on the agenda is just a one-page write-up that Investment Officer Brian Starr put together. This was a question raised by Trustee Menon at the IC, I believe, and who wanted to know, how private markets are faring in this environment. And so we put together what we have found. So certainly happy. It's fairly straightforward. We're certainly happy to take questions on that at any point. Now, going back to this discussion, if we can go back to Makita slide 6. I'll give Linda a minute to go back to Makita slide 6. Perfect. Thank you, Linda, Barbara. So the question, and before we open it up for questions of Makita, Veris, and myself and discussion, the question before us today is, do we want to stay at mix A, certainly an option at 70-30, or do we want to move to mix B or mix C? And certainly with each of these mixes, we ratchet up the risk level. Now, the other side of the coin is we keep talking about risk, but greater risk also means the potential for greater returns, the potential for improved funding status, which is good for our beneficiaries, good for our sponsor. And of course, the question, I'm sure we will discuss this in greater detail in terms of timing. But if you look at, just to highlight some things, if we move from mix A to mix B, we're really moving public equities by 3% and private equity by 2%, private assets by 2%. So perhaps not a very big change. And if we go to mix C, we will be moving from 46% in public equities currently to 51%, and 19% in private assets to 23%. So a bigger shift there if we move to 80-20. So both mix B and mix C take on a little bit more risk with the potential of greater returns coming from both public assets and private assets. Now, if you look at the current mix, it may not seem like these are big changes, but it is important to keep in mind that we moved from a different level. So PNF prior has 39% in public equity, for example. So going from PNF prior to mix C would mean a jump from 39 to 51%. And so that's something to keep in mind as we discuss the various options. With that, Mr. Chairman, I will stop now and we'll be happy to take questions along with our consultants.
No, thank you, everybody, for the presentation. Prabhu, thank you for setting up the discussion. Just to reiterate, what's before us today is an option to either stay where we're at or to even move further up the risk profile. And we can always tie that to a certain level too. So think about that when we're having discussions and you're asking questions, because towards the end we'll have to come to an agreement on what we want to do. If that means staying put, moving forward, etc. So with that said, let's go ahead and I'm just going to go down the list again, starting with Drew. Do you have any questions or comments for anybody?
Yeah, I've got two real quick, Andrew. One is, Prabhu, after all the trustees have sort of made comments or asked questions, I think we're all going to count on you to represent not just what you and staff think we should do, but also Trustee Oswald, who spent a lot of time thinking about this and is not here with us. I hope you can convey his thoughts. He had some definite ones from the last call.
Absolutely.
Right, great, thanks. So we always talk about this thing, there's a comment now, grading on a curve or grading absolute. And the work that Danny and Veris has done is absolutely first rate, Danny. You did such a good job of explaining it. Thank you. And that is the absolute view. If we were the only pension fund in the universe, what would we do? It's important to remember, and Veris also included this in their analysis, but we're not the only pension fund. There is this thing called wisdom of crowds. So we're being asked to sort of do what's right for us right now today in an unusual circumstance, but hold in the back of your minds that over the course of the next couple of months, we're going to ask Veris and Makita and our staff to say, well, what do other pension funds do when faced with this? And if we've done this right, and Vince really has led us to here and set this up, we're prepared for this shock, Veris and Makita as well, and we know what to do. And 80% of the time, we seem to be lagging our peers because we're conservative. And this is the time probably not to be conservative. And so we're always, because of the unusual leverage we have that our actuaries keep reminding us of, I'd like trustees just to remember that we are conservative most of the time, and there is probably a time to not be conservative, and that's probably now. Thank you, Andrew.
All right, thank you, Drew. Eswar, you have any questions for anybody? Comments?
Yes. So first, a couple of questions for Veris. So slide 6 of your presentation. So if you go there, those volatilities, those are prospective volatilities based on the asset allocation.
Yeah, that's correct.
And the volatilities, these are calculated over a long period of time. Was it like 10-year?
Yeah, that's correct.
Okay. And do they change if, I mean, you've gone through a very volatile period. So if you were to run this, say, the middle of the year, would you see these numbers change where something which is in a green zone or, moves to the yellow moves to the red?
Yes. Yeah. So the system that we use here to monitor risk, we're actually monitoring the risk of the implemented portfolio in addition to all of these kind of static different mixes, right? So what we care about is what we're talking about here is where does the policy or the strategy fit in the context of these operating zones? And then each month we report on where that sits, where the policy sits, as well as where the implemented portfolio sits in terms of these zones.
Okay. So there's a risk these numbers could look a little bit different.
Absolutely.
Okay. Slide 4. So if you take the example of the 11% risk, 95% CVAR, so you're saying that a 22% drawdown would happen once every 20 years, is that?
Yeah, that's what the kind of that statistic would predict, is that you would have a drawdown once every 20 years, and the severity of that drawdown would be 22%.
Okay. I mean, I guess except that in the last 20 years, we probably had like 3 such drawdowns, right? I mean.
Yeah. So the idea here is the board has to home in on their risk tolerance, right? So the point here is, as you move further left on this chart, you're being more aggressive, right? You're assuming that drawdowns will be lower than if you move further right on the chart, where those different metrics are capturing higher drawdown amounts. So what we're saying is, if we increase our confidence interval, or if we start using scenarios that are not based in statistics, right? They're based in actual history, what we've seen happen. We tend to get more conservative in how we estimate a drawdown impact.
Okay. And then if I can go to the Mikita presentation, page 28. So here, so these are expected returns. And again, these have not been adjusted based on the current market environment. That's correct, right?
Yes, these are actually from last year, because not all of these respondents have put out their 2020 expectations yet.
Okay, and so for US large cap equity, for example, you have a 10-year expected return of 6. Emerging markets 7.8. On the private, I'm interested in the private market side. So on private equity, you have 9%. Private debt is 7.4. So those numbers, are higher. And supposing you go through an environment like this, where, I would expect that when you revise these numbers, maybe, everything is higher. Would you expect that you'd expect the private market side numbers also to be higher because there's more opportunities there too?
So I think there's a couple of dynamics here. So this is the 2019 information. I would say that all of the respondents, for the most part, when they used 12/31/2019 information and redeveloped their 2020 expectations, these numbers probably all came down quite a bit. Now in the current market environment, though, with valuations looking much more attractive, they'd all probably come up. So where they would be exactly relative to these might be pretty close to what you're seeing on this slide. Given that these are last year's numbers, they came down. Now, if everyone were to revise them, they'd come back up again.
Okay, okay. And is there any data in terms of how, I guess big downturns like this affect the relative attractiveness of these different asset classes, meaning that are you going to see more opportunities in certain areas versus others?
Yeah, I mean, I think from a global macroeconomic standpoint, a lot of folks are really concerned about credit markets right now. We have historically low interest rates, even though the federal government is buying a lot of debt. I think a lot of folks think that equities are more attractive on a relative basis. You still continue to see pretty depressed valuations relative to history for emerging markets equity and to some extent non-US equity as well, given that even with the recent downturn, US equities have still held up much better over the past several years than non-US.
Okay, thank you. So, Mr. Chairman, I would actually, agree with Drew, and this goes with, kind of the discussions we had in the IC, that this is probably a time for us to maybe increase our risk. The only thing I would say is that, I think maybe if we have some flexibility, give the investment staff some flexibility, and maybe they can work with the IC, where if there are compelling opportunities on the private side, that there is a capacity to maybe act on those also. That may be, a better way of approaching this. So increased risk, but maybe with some flexibility in terms of increasing allocation on the private market side too.
And Eswar, just to elaborate a little bit more on that comment, since on the private side, we do have, especially on the private equity, we do have a lot in proxies. Are you saying just taking the money from the proxies, or even though we have not allocated all our private equity dollars into something yet? Basically, where do you want that money to come from?
In terms of an increased allocation to private markets?
Yeah, I mean, are you trying?
I would say, yeah. So I would say that if let's say we go to the 75, 25. So I would say that maybe there's some flexibility where if we initially have an allocation to public equity, but then maybe over the next year or two, we have the flexibility to take some of that public equity and move it to private equity.
Okay, I hear what you're saying.
Okay.
One thing I'd point out on that topic is that both mixes B and C would increase buyouts by 2% or private equity by 2% relative to the one that was recently implemented. So both of those do incorporate some additional private equity.
Right, except that I think what we recently implemented actually brought that down from what was a prior allocation.
That's correct.
All right, do you have any other questions or comments?
No, that's it. Thank you.
Okay, thank you. Nick, you have any comments you want to make, questions you have for the staff or consultant? All right, Nick, if you're still on but stuck on mute, I'll come back to you at the end. All right, Howard.
Yes, this is Howard. Yeah, thank you, Eileen and Danny and Laura for the analysis. It's very good. Just to go back to what Trustee Menon was talking about with on the Veris slide 4, and maybe this is for Prabhu because since I'm relatively new, the 12% limit on the risk tolerance was that set at a different time, and was that different than last year's, or is that different from what was in the IPS?
Trustee Howard, that was actually a Veris study that was conducted about 2 years ago. And Danny and Eileen jump in if I'm not getting the dates right. And they actually canvassed trustees and stakeholders, various stakeholders, I believe, including our sponsor, to come up with those numbers. And that was about 2 years ago.
Okay. Okay. And one other, so going back also to about the private, I agree. I think that flexibility of shifting into the private markets, whether it's buyout or even private debt, and I think maybe someone will talk about credits later, that might be an opportunity. One question I do have also on the memorandum on the update on the private markets, which I thought was very good. It's very succinct. At the very end, I think Brian mentions in a capital constrained environment that staff is spending more time educating the market on how we can be a solution provider for general partners looking for attractive opportunities. What examples of that would there be?
Probably, do you want me to take that?
Please.
So, I mean, this is almost like an investment banking statement, right? Where it doesn't say anything, but it says we have money, you just have to pay for it. And really, this is a variety of things, from investing into specific opportunities where general partners haven't fully closed on a fund yet, whether it's providing liquidity for other limited partners or in a fund restructuring situation, potential co-investments alongside GPs. It's really meant to encompass a variety of options that depend on the specific situation where we can underwrite both the general partner and the specific investment.
Oh, okay. And just to follow on that question, in terms of if you look back to the investment mixes, where would that kind of flexibility come from? Would it come from, I guess, on the private market side?
Yes, sorry, this exclusively refers to what we're looking at in private markets, and it's still constrained by both the pacing plan and the discretion that's allowable within the IPS.
Okay, all right, well, great, thank you.
And maybe one thing I'd add is that, with any asset allocation, we recommend having target ranges, and you do have in your investment policy statement the ability for the Prabhu and the staff to rebalance. So, even if you adopt a particular, exact amount in a certain asset class, there is still some flexibility to take advantage of the current market environment.
Okay, all right, great, thank you.
Thanks, Howard. Trustee Santos, do you have any comments or questions?
No, I'm fine, thank you.
All right, thank you. Vince.
So when we had our special board meeting or emergency board meeting, that was sort of the second meeting to address what was taking place in the markets. And the markets were moving so fast that I thought we really needed to see other more distinctly different risk scenarios. So this is perfect. If we look back over what's happened in this time frame, when the investment committee met in mid-March, it was March 3rd or March 11th, the markets were down 20%. Then a week later, we had the special board meeting, the markets were down 30%. And that's where we were looking for, if the markets continued to move faster and more towards the downside, higher risk models. We, from peak to trough, have declined about 35%. So we've actually gone beyond those numbers. What we, I think, should be looking at is using the weakness and buying into the weakness as a means of driving up our risk and, in effect, acquiring assets at cheaper and cheaper levels. But I think we have to be careful because there's a great deal of unknown at this point in time. While the market's really good at pricing things in, analysts are dealing with very much imperfect information right now. And we see that just by a couple of the data points that have come out on unemployment. They've been widely off the mark. And so we really don't know what the extreme damage will be to the economy and to profitability and hence prices for stocks. So I think we do need to consider moving to model B and C or asset mix B and C, but I think we need to be very explicit to staff on when we make those shifts. And my recommendation to this board would be upon further drawdowns. So if we have moved the last time when the markets were down approximately 30%, if we go down a level of 40%, I think we should be looking at shifting to asset mix B. And God forbid, if we go down 50%, we should be looking at asset mix C. The data that Prabhu had seen in the past, which shows some historical bear markets, those were actually going back to the 80s, about 40 years of history. But if you go back to the Great Depression, the average bear market decline's been 44%. And we've actually had 3 periods of time in the last 100 years or so where we've seen declines of 50% or greater. So I hope that doesn't happen, but I think those are the opportunities for us to be dialing up risk. The only thing for me that would prevent me from staying where we're at and consider adopting model mix B now is the fact that interest rates are so low that it's going to have a negative impact on our ability to achieve our assumed return. And we're talking about a yield of 0.6% on a 10-year treasury. It makes it very difficult, even if we're shifting towards some investment grade and high yield, to achieve our assumed returns. But I think that we made some smart moves in the last month. Staff initially overweighted equities at the IC meeting. We moved to a more aggressive asset allocation when the board met. I think we need to be very strategic in how we move and taking on more risk here. And we need to be careful of being a little hasty, because at this point, we don't know what the implications will be to the economy.
All right, thank you, Vince. Franco, you have any comments, questions for everybody?
No, I'm good.
All right, thank you. Nick, are you back on the line?
Can you hear me now?
We can. You have any comments?
Okay,
questions?
I've been on. No, but I do want, for the record, I want you to know that I've been on the line the whole time.
Okay.
I think maybe the host had me muted, but I'm back and I've been listening and everything. Thank you.
All right, perfect. Okay, thank you. So, I'll just make a few comments. I think I am, like most people that I'm hearing so far, in alignment that I would like to eventually get to the get to, you know, B or C. And this is something that we've been waiting for, you know, this opportunity to readjust our risk profile in the portfolio. We've been trying to wait patiently for several years to take advantage of an opportunity like this. But then also, I don't want to jump the gun. There was discussion at the IC meeting last week in regards to, you know, do we tie this to a certain threshold of, you know, of the S&P, you know, is that 2,800, 2,500, 2,400? And that's where I'm unsure about. I mean, I definitely want to get to mix B. It's just how do we get there and when do we get there? And that's my only concern. And I would like to hear from staff in regard to their viewpoint on where they would feel comfortable in making this transition. Other than that, you know, in regards to the different mixes, I don't have any specific questions. For me, it's all about timing and what's the appropriate time to do it. But I definitely would like to get to that point for our portfolio. So I don't know if you would have any comments, Prabhu, in regards to that.
I do have a few comments, Mr. Chairman. Thank you. And if we can go back to Makita slide 6 as the basis for our discussion. That would be useful. Firstly, I'm just going to address some trustee comments and also sort of give you my own views. So Trustee Lanza pointed out, rightly so, the crux is really, the new slides put together by Danny. Excellent slides, which show that even with mix C, we are still within, it's not outlandish in terms of risk. So that's, and we also know the numbers. And obviously, these are predictions based on statistical models, but at least we have an idea there. And Trustee Lanza also mentioned this is not the time to be conservative. And I think everyone's in agreement with that. We've been waiting for drawdowns for a long time. And as Trustee Sunzeri mentioned, we moved quickly and we took advantage of the first phase of the drawdown. We didn't time the bottom perfectly, which was 2,200 about, but I think most of our purchases were around 2,400. Trustee Lanza also requested that I convey what Trustee Oswald mentioned at the IC. And Trustee Oswald was in agreement with moving to mix B as long as the S&P stayed under 2,800. And we heard some other numbers here and I'll refer to them. And he was of the opinion that we should go to mix C if there's a 50% drawdown, similar to what Trustee Sunzeri said, which would put the S&P at 1,700. Then I'll move on to Trustee Menon's comments. He spoke about the relative attractiveness of private markets versus public markets. And I fully agree that there could be opportunities here in private markets. And in fact, if we go back, I've seen some venture data which show that, and even in private equity for buyouts, the best vintage years were those after the great financial crisis. So in the next year or two, beginning now, we may have some tremendous opportunities there. And in terms of increased allocation to private markets, we make the allocation to public markets now and then shift to private markets as opportunities present. That's something we can sort of work with the IC and figure out how best to do that. And Trustee Lee mentioned this as well in terms of the attractiveness of PE buyouts and credits. There's a couple of ways. The other way of doing it, of course, is if we have a pacing plan and if we find that there are really good opportunities, we can always work with the pacing plan as well. Finally, Trustee Sunzeri mentioned, going to mix B with a 40% drawdown. That would put the S&P at about 2050, 2040. And so that would be in another 10% or so decline from here. And then to mix C at a 50% drawdown, which would be 1,700 on the S&P. So I think all very reasonable suggestions. It looks like everyone is of the same opinion, as am I, that we should move to mix B. Now it's a question of tying it to, when do we do this? So it's hard, at some level when we tie this to the S&P, we are sort of timing the market, and which is a difficult exercise in my opinion. I still understand and agree with the logic saying that we are at a certain level today and we've moved quickly. And if there is another 10% drawdown, we could tie that to moving to mix B. But if you look back, if you go 6 months from now, 6 months from now, who knows? Right? The market we may have gone to mix B or mix C, and the market may be down another 30%, and our plan will suffer for that. But if we take a long-term view, and if we go out 5 years or 7 years, I think this is the absolute right move. Whether it's 2,200 or 2,300 or 2,000, I think we'll look back and be glad that we've taken on more risk because it has the potential of greater returns. So again, I'm in agreement that we should move to mix B. That would certainly be my recommendation. And Trustee Sunzeri made a specific recommendation, which I'm very comfortable with, which is about a 10% drawdown. Actually, that would be greater than about a 20% drawdown from current levels would be a 40% drawdown from the peak, which would be moving to mix B. So the last, we hit the bottom at about 2,200 a couple of weeks ago. We could retest that bottom. It's hard to say. Could we go to 2,000? We could. Again, none of the analysts on the street have a good handle on this. As Trustee Sunzeri mentioned, I've looked at Bank of America so far has been the most pessimistic in terms of earnings, and they came out with the S&P at about $138 a share. And at 16 times 138, that would put the market at 2,200. And at 15 times multiple, that would put the market at 2070. So, you could split the difference. Again, it's very hard to time these things, but I'm in favor of moving to mix B, and we just need to come up with a consensus on what that range should be, as opposed to a single number, because, if we say at 2,400, we could easily miss that. But if there is some range, if we say between 2,200 and 2,400, or between 2,000 and 2,200, that'll make it easier for us to work with that.
Thank you.
Andrew, can I make a motion?
Yes, you can make a motion. I still want to get a couple of people that haven't spoken in. I wanted to ask Councilmember Foley if she'd like to make a comment, and see if Harvey and Roberto want to make any comments. But you're welcome.
Let them do that first then.
Okay. All right. Thank you. Councilmember Foley, is there any comments or questions that you might have? All right, we'll go ahead and move on. Harvey, do you have any comments or questions?
Thank you. Hold on. You can't see me, but in light of the CIO's comments, which marries, we're talking about the risk in the portfolio. The reason we're talking about that is the potential, as Prabhu mentions, the potential of greater returns. And so I'd like, on behalf of the board, I'd like to broaden the discussion a little bit beyond just looking at the asset mixes, to get a little bit more information, if you don't mind, for the board to consider in two regards. One, I'd like to ask both Makita and Veris about any changes they anticipate in their capital markets projections on which these return anticipations are based, in light of two things. First, the current T-bill rates. I think Trustee Sunzeri rightly observed that when we put a real return on top of risk-free rates to come up with our capital markets projections, we're at rock bottom on the risk-free rates at this point. Does that impact going forward their projections of the capital markets? Also, what inflation expectations they would have given the actions that the Fed has taken to capitalize the markets, both the Fed and all other central banks. Would they anticipate in the next 10 years this is going to lead to a level of inflation much higher than we're currently anticipating, and how does that impact their capital markets projections? And then the other item I'd like the board to spend a little time on is to go back to Veris's slide 5 and talk out of the context of just considering the investment returns in a vacuum, and put it in the context of the ability of our plan sponsor, our only plan sponsor, in a 20% drawdown, to be able to contribute in a single year an additional $116 million in context of the economic impact that this downturn may have and the layoffs, furloughs, that sort of thing that might be coming along. Because ultimately we're looking for these returns to pay benefits. And a big part of that equation of paying benefits is our plan sponsors' ability to make contributions so that we can invest at a level that will give us the expected returns that we want. And so I'd like to spend a little bit of time focusing on our cash flow and the city's ability, if we take on additional risk, to make a significant increase in the city's contributions during this period. So thank you. I don't want to prolong the conversation unnecessarily, but it seems to me that we need just a little bit more context in which to consider increasing the risk of the portfolio. Thank you, Mr. Chairman.
Andrew, this is Councilmember Pam Foley, and I'm sorry that I stepped out for a minute when maybe you asked me to speak, but I appreciate the conversation about increasing risk, but I am very mindful of the city's increased contributions and the that may or may not result. The baseline of 225 million is might be difficult for the city to meet. Of course, that's our obligation given the baseline. But the COVID virus is having a tremendous impact on our fiscal ability to move forward. And we may see already for this fiscal year that we're in the midst of a reduction on expenditures and services. And going forward in 2021, we may see a dramatic reduction in anything beyond core services for the city. This is really causing a huge financial impact to us. And we're in the middle of the budget process right now, or we're heading into the middle of the budget process. And what the mayor's message was a month or so ago is pretty much off the table. So I'm very mindful and appreciate the conversation around the sponsor or the city's contributions, because while it's our obligation, it will impact our general fund and our ability to provide other services, including, which I was hoping to increase our hiring of police and fire this year, which we desperately need to do. So this is a difficult time for all of us, but I'm very mindful from the city's point of view, and I appreciate that part of the conversation being entered in at this point.
Thank you both for making those comments. Without trying to, to stay on topic, Councilman Foley, have you starting to hear any numbers from your side on how the revenue is going to be impacted? Specifically, I mean, retail revenue for the city is, probably it's dropped significantly since, the shelter in place is going on. Is there any early projections that you are hearing that you are able to share?
I'm not hearing any specifics yet, other than obviously the entertainment industry is way down. So our TOT taxes, our hotel tax is way down. Our sales tax is way down as people are staying home and not shopping as much. Property taxes are due, so we'll see if people actually pay their property taxes. That will impact us a little bit. But I haven't heard any numbers other than from the city manager that he's coming out with a proposal that may involve reductions of services in this fiscal year. So I haven't heard anything yet other than be aware it's coming.
Okay.
Mr. Chair, this is Roberto. I understand that discussion,
is scheduled to take place at the City Council at their upcoming meeting on April 7th. So we'll know more about it after next week.
Okay. Okay. Yeah, Roberto, I mean, when you do hear something from that meeting, yeah, please pass it on, because that's something that we definitely need to be thinking about as trustees. And I know this is a topic that I think we could really tackle when I believe, not Varus, Chiron's going to be coming next month to talk to us. Is that correct?
Yeah. So if I may jump in now, if I may.
Absolutely. Go ahead.
Comments, if you rather me, I can wait. So thank you, Council, for those wise comments. You know, you've been doing those for now 18 years, so I'm impressed, Council. But in any case, so a couple of things. I was going to mention some of this information during my audit report. I have kept both boards, chairs, and vice chairs apprised of this situation. So I've been in communication with Chiron. They want to come before your board. I think the concept is to come before your board this fiscal year, but as close as possible to June 30th, which actually kind of limit Chiron coming to speak to police and fire probably at the June meeting, and then for Federated either be their May meeting or maybe the June meeting as well. And the reason for that is we would like to have as much of a clear picture of the impact of the market downturn for the 2020 actual evaluation, because certainly it would impact contributions for future years. And so the concept is the closer we get to June 30th and the better picture we have of the impact, the better discussion can take place at your board in terms of finding policy changes to mitigate the short-term impact of these contributions. It's kind of hard to say what those policy changes may be, but you can think, for example, of your amortization period, right? And other policy-related changes that your board may want to consider to deal with the impact on the plan sponsor of the contributions. And that's just one of the many discussions that Chiron is going to have with you, both boards. And taking that discussion and specifically referring to slide 5, which are actual projections, it would be helpful to understand from Varus, although I think I know the answer. The numbers that are here, obviously they're estimates, but I think they're on a market value basis. In other words, when we do the evaluation for 2020, the contributions are going to be based on an actuarial value. Especially on a big downturn for 1 year, we're only going to be accounting for 20% of that. So there is going to be the actual return will still be considerably lower, even maybe negative, but it will be very different than the actual market value return. So we could have for the year, we could have a 30% market return negative, but on an actual basis, it may just be 5% minus 5%, which is still obviously a very bad return, but not as big as the market return. So I want the board to keep that in perspective when they look at these numbers. And in addition to that, again, your board will be then having discussions with Chiron about policy changes that hopefully could mitigate that short-term impact of the plan sponsor in the next couple of years. So I just wanted to mention that. In terms of the mixes, I'm a big supporter of moving to, is it mixed B? I don't see it in front of me right now, but the 75-25%. So I'm just sort of in line with the comments by our CIO and some of the trustees. And the reason I think that we should be considering doing that sooner rather than later is we have Varus as our risk consultant, and I don't know if I'm saying this correctly, but the operational basis, those areas that are green, yellow, and red, even moving to that mix B, we're still in the green area. So I think that that move should happen sooner rather than later, and then obviously condition any further dialing of the risk to further deterioration of the market. We recognize we can't time the market, but as I think the CIO suggested, having some range that the staff can be considered, so that if we have to dial up the risk, we can do that. That will be helpful. But in terms of at this moment, we have been very patient. We have been telling the plan sponsor for 7 years now that we have taken less risk than our peers. And I think this is the moment that we have been waiting for, to really dial up that risk, and dial up the risk to a 75-20 still will keep us in the green zone of risk. So I think, that should be the concept. And I think that's what the board, my recommendation in support of the CIO comments and some trustees, to move there now, and then any further risk could be, again, given specific thresholds within the S&P. Thank you, Mr. Chair.
Yeah, no, thank you, Roberto. And to get back to some of Harvey's questions and comments and concerns, and Councilmember Foley's, I'm definitely, it's been in my mind about the sponsors' revenue and how that's going to impact us, and what can they afford, knowing that services might be reduced and stuff like that. And the investments for the portfolio and investments returns, they do overlap with the actuarial stuff. But at the same time, I believe that the best way to help the sponsor and the city, and ensuring that we have a proper revenue coming into the plan, would be addressed when we talk about the actuarial stuff, the discount rate, the gain and loss of smoothing, the amortization schedule. And we've always talked in the past, every time we come up with the amortization schedule or talking about the actuarial stuff, is that when times are good, let's be aggressive on our schedules, and try and fund and make whole the pension system as quickly and fast as possible. But then during bad times, downturns, let's pull back on some of those levers, and trying to find that balance. And I have in my mind, that's what I hope to achieve in the next few months, when we start having Chiron does come back to us, that we can revisit that and find a way that's best for our plan here. Because that's what we have, fiduciary responsibilities for. But then also, to take in consideration of our sponsors and our membership. Harvey, I know you had specific questions, and I think it might have been directed to our consultant. Do you mind reiterating what slides you wanted our consultants to talk about, or for us to talk about?
No, it wasn't a particular slide, Mr. Chairman. It was more on just getting an understanding in the current context of the markets, whether Makito or Veris were anticipating changes in their capital market, their expectations of risk reward in terms of capital markets projections, based upon both the near zero current risk-free T-bill rates and the impact on those projections, and also whether they're anticipating that eventually we're going to get out of this central bank intervention is through inflation, and whether they're changing their inflation component expectations of their capital markets projections.
Yeah, I can discuss those questions briefly. Thank you, Harvey. In terms of capital market expectations, any given day, if we were to recalculate them, they would be different given how volatile the markets have been day to day. That said, the effect of lower interest rates will flow through to essentially all of the capital market expectations, given that they're a building block that we use. However, that said, we think there will be a bigger impact from lower equity valuations. And if you take a look at slide 6 and you look at mix A or the current relative to mixes B or C, you see a lower fixed income rate. You know, you went from 14% in short-term bonds. Now we're at 12% in investment grade, mixes B and C. Take that investment grade bond allocation down to 8 or 6%. So the impact of lower interest rates would be less on mixes B or C than the asset allocation where we are right now. So we will at some point this year recalculate our capital market expectations. It's difficult to sort of determine when that should be. So I think we're looking at sort of June 30th, just to use a sort of midway through the year date, since it's going to be arbitrary whatever date we choose. But I would expect that all of these long-term expectations for returns at this point would be slightly higher than where they are now. In terms of inflation, that's something that's very, very difficult to predict. It could be a risk in the future. And that's one reason that on some of our additional slides in this presentation, we do look at the impact of inflation or rising interest rates. For example, the economic regime analysis, which is on page 15 of the Makita presentation, looks at how a shock in inflation would affect each of these different asset allocations. The prior allocation that's already been moved from would have been about the same as mix C in terms of being exposed to inflation and having a positive return. So if you look, there's not huge differences between the mixes that we're looking at. The peer median and the 60-40 would not have that same positive bump from inflation risk and an inflation surprise. One of the reasons that we try to stay really diversified, if you take a look back at page 6 at the different asset allocations, is because, when you have a different, you have the asset classes that sort of zig and zag in different ways. Real estate might do better in an inflationary environment, fixed income might do worse. And so we try to just diversify those risks. In terms of the trade-off with the sponsor, your question about sponsor contributions, of course, we know that's a huge issue for the board. It's one that is very difficult. Sometimes we feel like you can't win because, if you take less risk, you underperform peers in an environment like 2019 and when markets are up. And given that, sometimes you don't get the credit you all deserve for taking less risk and protecting in a market environment like we have right now. So obviously a huge trade-off. In general, markets have gone up over long periods of time, which would indicate that taking more risk should be rewarded in a returns basis. But of course, it's very, very dependent on the specific market environment that you have at any given time. And unfortunately, that's something that we can't predict.
And if I could make a comment on the inflation aspect, this was a big fear, if you recall, from all of the stimulus that occurred after the global financial crisis. And as you know, we did not see really meaningful inflation. We were only recently starting to see inflation actually from underlying wage and salary growth, which took a long time. And unfortunately, we're in this environment. So I think the issue is, it's not just the flooding the system with money. That money has to move around the system. And that has to do with the velocity of money. And that's what's really been absent. That's why we didn't see inflation after the global financial crisis. And it remains to be seen whether that comes back. But that to me is another variable that we consider anyway when we're developing our forecasts, short-term forecasts for inflation. Also, to answer, if I could, sorry, CEO Pina's question, we do use the actuarial value in that slide 5 to create the funded status. So we are apples to apples with the actuary in terms of presenting that information.
Thank you, Eileen and Laura. Harvey, did you have any follow-up questions to their comments?
No, thank you, Mr. Chairman. That's good. I just wanted to make sure we had a good record of considering those, the context in which some of these decisions will be made. So I appreciate that. Thank you.
All right, thank you.
Andrew, can I jump in on this issue? I mean, Harvey, you raised what is actually a very deeply philosophical issue. And I would answer it this way. They could have put the money under a mattress when they created this pension fund, but they didn't. And they chose deliberately, not just us, but everybody, to incorporate some risk because the future would, in all likelihood, be brighter. The future is not always brighter. Countries go to war and lose wars. Pandemics like the Black Plague wipe out 50% of the people. And I think it's our job, Harvey, to pick, and this is where Varus has done such a good job, a percentage of cases. And it's not 99%, Harvey, it's probably 95%. There is always a, God, pick the number, Harvey, 1 in 70, 1 in 100 chance that the whole world falls apart. And it could happen with this pandemic if the virus mutates, right? And I just think that is not our job. We were not put in charge of money under a mattress. We were put in charge of money that was deliberately at some level of risk. And I think we are doing this exactly right, Harvey. We are trying to calibrate both absolute and relative risk. I think we're doing this right, listening to Councilwoman Foley. You know, let's not kill the sponsor, but there is always a way, Harvey, through this maze where we all die. And I just think we can't go to the 3 sigma point. We have to go to the 2 sigma point, maybe somewhere between the 1 and the 2 sigma point. So if a future generation ever hears this, yes, we take risk. And that means by definition, the way the very inception's planned, in some sets of circumstances, you go to war and you lose. In some sets of circumstances, a virus kills 50% of your people. I don't think any of that's going to happen, but if history is any indicator, we can certainly point backwards. I don't mean to be all gloom and doom, Harvey, but we do need to pick some level of risk.
Thank you, Drew. I wanted to get back to Vince. Vince was going to make some comments and possibly a motion. Vince, are you available?
Yeah, absolutely. And Harvey, thank you for teeing up some of the other discussions, because those are some of the things that are forgotten when we talk simply about markets, asset allocation. We need to take in consideration our members, the makeup of the plan sponsor. The first comment on capital market assumptions, it's important to understand that when markets draw down like this, future returns will expect it to be higher for equity markets. So that actually will have a positive impact on what's happening. Maybe that's enough to offset the lower expected returns from fixed income. Secondly, on the city side, one of the things we talked about in our retreat is that when we got into an environment like this, we could start to pull on some of our other levers to possibly provide some relief, amortization schedules being one of those. We have been very aggressive in trying to get contributions in using short amortization schedules. And one tool we have could be to look at adjusting that as we get into a difficult climate from the financial perspective for the city. The third thing is on the Varus slide 5, where they're showing these drawdowns. It's important to understand that that is from the peak to trough with those given how we are at this point. We're somewhere along that path. We're definitely beyond the beginning of the drawdown. So if we did shift to another portfolio, it doesn't necessarily mean that we're going to see those kinds of drawdowns, because we're drawing our risk up after the market has seen a decline. So I just wanted to make those points to help stand. My motion will be to direct staff and give them the authority to shift from where we are now to asset mix B. As the markets draw down anywhere between 35 and 40% from their highs, and to shift to asset mix C if markets decline greater than 50% from their high. Markets I would refer to, we've been talking about the S&P 500, but the reality is we're using proxies such as the Russell 3000 and the MSCI ACWI. I would include any of those indexes as measures of these drawdowns. So it could be the S&P 500, it could be the Russell 3000, or it could be MSCI ACWI, IMI. That's the motion, Andrew, that I wanted to put forward.
Thank you, Vince, for the motion. Do I have anybody that would second that motion?
Can I?
This is Trustee Lands. I'll second that motion.
Okay, so we got a motion by Sinceri. We got a second by Lanza. Let's have further discussion. I heard Eswar wanted to make a comment.
Yeah, so should we take it one step at a time, that we say the asset mix B and review once we reach there before we go to the, give the direction to go to C directly? Should you make it a two-step process is my question.
You mean in regards to the motion, or?
Yeah, or should we do a motion mix B?
I'm not opposed to that.
Sorry,
Eswar, I'm not opposed to that. I'm just trying to be responsive to what are fast-moving markets, and that we don't have to go back and have another long, extended debate around asset mix C. So that's why I included both at the same time. But if you want for now.
Hey, Harvey, remind us if Prabhu said, ooh, I need a vote of the board. It's a super duper emergency. How quickly could this board be convened and vote?
24-hour notice. So we could call a special meeting.
Yeah, so what Eswar is saying would make sense. We could, if Prabhu sees it coming, we could meet and vote within 24 hours. Or at 24 hours.
I just think that, I don't think it would change a decision, but we should just review all the facts and then, make the decision to let's go and increase allocation again.
So let me amend my motion to strike moving to asset mix C on a drawdown of greater than 50%. The first motion would be that we direct staff to increase the allocation to asset mix B on drawdowns between 35 and 40% for any of those three indices that I mentioned. And they have the latitude on.
Oh, sorry, Vince, go ahead.
All right, so Drew, did I hear that you second that?
Yeah, the seconder accepts the amendment.
Okay. Any other trustees have any comments that they want to make? Sorry, who was that? All right. Is there any public members, anybody from the public that is on this call that would want to speak up on this topic? All right. If there is no public members, we do have a motion on the floor by Vincent Serra. We have a second by Drew Lanza. Let's go ahead and do a roll call vote. Trustee Lanza.
Aye.
Menon.
Aye.
Muyo.
Aye.
Howard Lee.
Aye.
Santos.
Yes.
Sanseri.
Aye.
Votto.
Aye.
And myself, Gardenier. Aye. So that passed 8-0. Thank you, everybody, staff, Makita, Varus, for putting this great work together. It was a quick turnaround from our last meeting, so definitely appreciate the hard work. Prabhu, is this enough guidance for you guys, and you feel comfortable on what was decided here?
Yes, Mr. Chairman, that was very clear. Thank you.
Okay.
The chair, if I might just ask before we move from this topic, if Brian and Prabhu can tell us, and maybe this is for the next investment committee meeting, what they need in terms of having the flexibility to maybe consider private market deals opportunistically. So maybe for the, they can come back and tell us what they need us, so what guidance we need to give in terms of being able to participate in those things.
That sounds good, Trustee Menon. We'll certainly have a discussion internally, and we'll bring it for discussion at the next IC meeting.
Thank you.
All right, thank you both. Let's go ahead and move on to 3A, old business, discussion action on revised administrative budget for fiscal year 2020-2021.
Yeah, thank you, Mr. Chair. Barbara or Linda, if you can, yes, so that's the presentation. This is really very straightforward. I'm going to go to slide number 2. The only difference between what you see here this morning and what was presented to you last month was one position. There was a information system analyst position that we have requested for another year. That was a limited day position. We are now requesting to delete that position, which changes the request. The total request originally was $6,485,000. With the new request, that new number is $6,368,000. So it also decreases the personnel total from the original $1,188,000 to what you see here on slide 2, $4,071,000. And if we move to slides 4 and 5, because we were requesting, in addition to extending the ISA, we were requesting an additional position on the investment side. Our total positions numbers increased from 39.75 to 40.75. This brings us back down to 39.75 positions, which is actually 19.875 positions per plan, which is the same level that we have been actually over the last 3 or 4 years. So I would request that you board, the request is that you approve the new revised administrative budget. But before you do, I just also wanted to share with you, again, I share information with you, board chair and vice chair, more often than I'm sharing information with the full board. But I also wanted to let you know, I think council member also spoke about it, the implications of the current situation, COVID-19, on the city budget. And so we receive a hiring freeze information from the city. And so I just wanted to let you know that right now there's a hiring freeze. And so I'm still moving forward with this request, which is adding the position, one position in investment, but is deleting one in the on the information technology. And I'm going to move forward unless I hear otherwise, either from your board or from the our mayor's contact at the mayor's office. They have supported initially, and I still believe they support this approach. But I just wanted to kind of let you know that on the side, that the city may be requesting having that economic impact. They may be requesting a few changes going forward. But at this point, I think is certainly reasonable for us to move forward with this approach. With that, I'm happy to answer any questions.
Thank you, Roberto. Any trustees have any questions for Roberto? All right, if there is no further questions for Roberto, this is an item that we need to approve. So I'll go ahead and make a motion to approve the revised budget. Do I have a second?
Trustee Lanza will second.
Okay, I heard Lanza first. So motion by Gardenier, second by Lanza. Any other comments? Any comments from the public that might be on the phone? All right, let's go ahead and do a roll call vote. Lanza.
Aye.
Menon.
Aye.
Muyo.
Aye.
Lee.
Aye.
Santos.
Yes.
Sinceri.
Aye.
Botto.
Aye.
And myself, Gardenier, aye. So that passes 8-0. Thank you, Roberto, and staying on top of the budget here and bringing up the changes. Yeah, and keep us posted if there is news coming out from City Council, and if there is a freeze where you can't fulfill those vacancies. Just keep us up to date.
Very well, will do. Thank you, Mr. Chair.
Thank you. All right, so that brings us to 4A, oral update from the CEO, Retirement Services.
Thank you, Mr. Chair. If you bear with me, a couple of things. You may recall I sent an email to both boards a couple of weeks ago, kind of giving you an update and a status on the operations at the office. And so I wanted to share with you the retiree payroll for March went without a hiccup. So we actually made all the payments, including a handful of checks that we have staff at the office for a handful of retirees that actually come to pick them up individually. We even delivered those. So again, big kudos to staff. And let me take this opportunity to say, thank publicly the whole staff of the office for their work and their efforts throughout these 2 weeks and obviously in the future. And really, honestly, their engagement. We have been on top of everything. And to that extent, I wanted to specifically also thank, I think the chair mentioned that at the beginning of the meeting, our military staff, Linda, Michelle, Marty, Barbara, our CEO, and Iran, our IT manager, for the work that they have done on making this meeting through Zoom happening. You may recall that I believe Tuesday was a holiday for the city staff, but we were having some Zoom meetings with trustees just to make sure that everyone was up to the task and this will go without any hiccups. So I want to especially thank the staff for making this happening. So thank you very much. But that said, the office is still closed. You all know that the county and the city extended the stay shelter in place through May 3rd. Which means that at this point, at least we're going to remain close to May 3rd. That will probably allow us, if anything changes, if we open after that date, to have your board meeting on May 7th at City Hall. But in the event that is not the situation, obviously we will have another meeting through Zoom on May 7th. And of course, in between, depending on how the market behave, we will also call for an emergency meeting if it's needed. In closing, I wanted to let you know I will be participating through Zoom at the City Council meeting on April 14th. We'll be presenting the results of the actuarial valuation. And I also wanted to let you know we are still taking retirement applications. So if there are city employees that want to retire through this process, we're taking applications online and through the phone so that we can retire them and pay them. And we have deleted, except for investment committee meetings, we're not having any more committee meetings, including disability. But you should know that in the event that we have a financial hardship on a disability application, that will be the only case that we will call for a disability committee meeting in the event that we have a financial hardship. We don't have any at this point, and so that's why we haven't had any disability meetings, committee meetings at this point. Lastly, obviously, because of the shelter in place, the retirement working group has rescheduled all their meetings, so they're not meeting in April. And you may recall that there was a joint meeting with the City Council in April that also will be rescheduled to a later date. Lastly, the CalPERS defined benefit plan for the investment professional is scheduled to go for discussion to the City Council on the April 14th meeting. So that concludes my comments. Mr. Chair, I'm happy to answer any questions.
Thank you, Roberto, for the update. Does anybody have any questions for Roberto in regards to his update? All right, we'll go ahead and move on. So we got to go backwards just for one moment. During the motion that Vince made on the asset allocation, we were having some technical difficulties with the audio, and it came across pretty broken. We don't need to go through the vote again. That one passed 8-0, but just for the record, and I'm just going to have Vince repeat his motion just to make sure that we have a clear recording on it. Vince, do you mind doing that?
Give it my best shot, see if I remember. The motion was for the board to authorize and direct staff to shift to asset mix B if we see a market decline from the peak anywhere between 35 and 40%. The markets would be the S&P 500, the Russell 3000, the NSC ACWI, any of those three indices.
All right.
Is that clear?
I think so. I heard that one pretty clear. And so that was a motion by Sinceri and a second by Lanza. I appreciate you repeating that.
Thanks.
So let's go ahead and go back to now 4B, oral update from City Council Liaison, Pam Foley.
Oh boy. These are the times that try men and women's soul, that's for sure. We have the shelter in place is no joke, and I'm really happy to see that you all are sheltering in place and hoping that you and your families are all safe and staying healthy. I worry, of course, about our first responders, our police and fire, our medical personnel who are really on the front lines of helping us through this crisis. And we all know that the reason we're in sheltering in place right now and that it's been extended to May 3rd is to flatten the curve and the impact on our medical services so that they're not overloaded. We had a special city council meeting yesterday. You've already mentioned about our budget concerns, but yesterday we heard an extensive update, as we do every council meeting now, on our response to the COVID crisis. And one of the the things that came up or that was discussed is the 3 challenges of now. And I'll just break those down into number 1 is the health of our community, saving lives. Number 2 is the economic health of our community, so saving livelihoods. The third, it relates to the city, and that's our fiscal responsibility in preserving our fiscal health. The shelter in place is having a dramatic effect on our small businesses, and actually all of our businesses, but many small businesses like restaurants and entertainment businesses, they can't do their job virtually. Restaurants are closing and keeping very small hours, as we know, but that's all for our health. Just yesterday, we passed an emergency ordinance to mandate sick pay of up to 2 weeks for full-time employees, and also a variation for part-time employees too. And the purpose is to encourage employees to stay home when they are sick, so they don't feel the need to make the decision of earning a paycheck when they are sick and going to work, and thereby potentially infecting others. We know that this virus, many of the people who are carriers do not have any symptoms, so they walk around asymptomatic, believing that they are completely healthy when they could be carriers. So it's really, really important that the methods that the county health officials have put into place, that we all honor those. And I know I'm preaching to the choir, but I send out newsletters and emails and tweets and Instagram posts daily on how important this is. As a result of folks not quite understanding it, or maybe getting a little stir crazy, the county closed all of our parks, not just their parks, but our city parks too, not to the hiking paths, but you have to maintain your social distance. But we've closed our playgrounds, our dog parks, golf courses, every place that someone might be interacting. People were playing tennis, and you may think, well, there's no problem there, but any ball that is touched and sweaty and might be infected could infect other people. So it may seem draconian, but it's serious, and we know from the deaths that are occurring in New York that this is not a laughing matter. I don't mean to get preachy, but I can't help it. Listening to the financial impact and our whole discussion today, it's a scary time. We have kids. I worry about my daughter. I know Vince has a grandson. Congratulations. Or is it a daughter? I forgot. Anyway, life goes on, but it's a very stressful time. So I'm proud that we passed the emergency ordinance on the sick leave. A couple of weeks ago, actually, the city was the forefront of passing a moratorium on evictions on April 7th, residential eviction. On April 7th, we will take up an emergency ordinance to impose a moratorium on commercial evictions. So many of our businesses are hitting the pause button. They aren't able to, especially after Tuesday's announcement, not able to go to work. Construction businesses and others have been added to the list of non-essential services. So all of this will have a long-term effect on and it will have a long-term effect on our city's ability to go forward. And as I said, we're heading into budget session. I have heard that there is going to be a hiring freeze. I know in the past we've had an essential service budget that each city council person has been given and able to allocate in their area to help their community, but that's probably off the table completely. How else our budget plays out, we'll know in a few weeks. But we are looking at this from a 12-week process and not a 1 or 2 week process. May 3rd is the date that we're ending theoretically, but it wouldn't surprise me if it gets extended beyond that. So with that, I just want to, since this is the Police and Fire Retirement Board, I want to give a huge thanks of gratitude to the police and fire, firemen and women who continue to put themselves in harm's way and their families in harm's way as a result of this virus. And that's it for me. Thank you.
Thank you very much. You made some great comments, and I like the priorities that the city council and the three priorities or challenges you guys are facing. It's unheard of times, and we're trying to figure this out as we go, and it's impacted so many people. And we could just hopefully, as a community, we stay healthy and not spread the virus. And your message of staying home, staying put, quarantine yourself, or shelter in place is very important. That's how it's going to spread. So thank you for the comments.
Thanks, sure.
All right, so let's go to 4C, discussion and action on committee assignments. So the reason this item came back onto our agenda today is because, as you all know, Trustee Vikas Oswald had to step down from the board immediately, and so which led a vacancy in the investment committee. He was chair of that committee, and then we had Eswar as vice chair. So that leaves a chair vacancy and also a spot on the investment committee for another member to come on. And in times where the board is having several discussions and constantly monitoring our portfolio, this is something that we wanted to get addressed. So when we last visited this back in December, there was this. We were very happy and fortunate to have two great candidates to become chair between Vikas and Eswar. And we would have been extremely happy with both of them serving. So at this time, I would like to ask if Eswar, if you would be okay of stepping in and becoming chair of the investment committee.
Yes, Andrew, I thank you for the honor, and I look forward to working with you and everybody else.
All right.
Go team.
Yeah, thank you. So that still leaves us with three people on the committee. We'd like to have a fourth person on here. I'm open for suggestions, but my recommendation is to see if Vince would be willing to come back onto this committee if it works out for him. I'm not sure how you feel about that, Vince.
I'd be happy to do it, Andrew.
Okay. All right. Perfect. So yeah, Harvey, is this something that we need to vote on, or is this something that, yeah, just have the discussion and we can move on to the next item? What do we need to do?
Honestly, I don't remember the charter. I don't remember whether the charter gives the authority to the chair or has to be voted on, but why don't we just get board consent?
All right. Yeah, let's be safe on this, and so we don't have to come back. Let's go ahead and just do a roll call vote for this. Actually, there's one other item that I wanted to cover on here, and Vince, please chime in here. I'm just observing that you're on multiple committees now. That puts you on the investment, the governance, and JPC. And in transition with Howard Lee coming on the board, I've always been of the mind of trying to phase in new trustees slowly so they're not too overwhelmed, because I understand it took me a few years to get, feel like I wasn't drowning, and I didn't want to throw too much on his plate. So how do you feel about the governance? Do you want to come off it? If you do, then I'll be happy to, we could try and get Howard Lee into that committee. They only meet on a quarterly basis. Either way, I was planning to just try and revisit this anyways, early summer, to get Howard back into one of these committees. What are your thoughts?
I think it would be great to have him step into my place on governance. It's just a matter of how quickly you want to do that.
Okay.
Having both joint personnel and investment committees a lot of time commitment. So I prefer coming off, but I don't want to rush that if you're not ready to move Howard or Howard's not ready to take that on.
Okay.
So whatever you want from a timing perspective.
All right, thank you. Howard, you want to chime in on here? How do you feel about this? I've spoken to you about, trying to, ease you in and to make sure that you feel comfortable. The governance committee, they meet once a quarter. I believe the next meeting is not until June. And the other people that are on this committee, Nick Muyo and Santos, they're very familiar with this stuff and been around on this board for many years. But how do you feel about jumping into a committee?
Yeah, thank you. Thank you for the comments. I think in the interest of the urgency of the situation with respect to investments, I'm happy to transition sooner or now to the governance committee. And as long as I have the help of the folks there already, I think I could hopefully be helpful.
Great, perfect. Thank you very much for being flexible in there. So in regards to then voting on this, then basically the changes that we'll be making is Eswar was going to become chair of the investment committee. Vince is going to come on as a member of the committee, and Vince will come off the governance, and Howard Lee will be joining the governance. Can I have a motion for approval of this?
So moved. Santos.
Santos, second. Do I have a second?
Muyo.
Muyo. Any discussion? Anybody from the public? All right, let's do a roll call vote. Lanza. Menon.
Aye.
Muyo.
Aye.
Santos.
Yes.
Sinceri.
Aye.
Votto.
Aye.
And Gardner, aye. All right. Thank you very much, everybody. Thanks, Howard, for being flexible and jumping on the governance. And we'll make sure that the transition is fluid for you.
Chair Gardner?
Yes.
I apologize. Did you also appointed someone to the Joint Personnel Committee?
Oh, so, okay. Have not, but I think that is in our charter that
It's Eswar, you're correct.
Eswar. So
I just wanted him to know that, yes.
Okay. So Eswar, thanks Roberta for bringing that up. Eswar, so the way the charter is set up is the chair of the IC joins the JPC committee. Are you okay with that?
Yes, yeah, thank you.
Okay.
Should I stay on the audit or, because that'd be 3 committees for me, or should I step off the audit?
Yeah, it probably would be helpful if you step off the audit just as we did for trustees and Seri, only because it is a lot of work, even though you both are giving up the bonus that you get for being 3 committees, but that's another discussion.
Yeah. Well, I can't travel much in any case, so the bonus is
which of course this is the chair discussion, but it would allow Trustee Lee to also join another committee, but I'll leave that to the discussion for the board.
Sure.
Thank you, Eswar, for bringing that up. I definitely overlooked that, and I apologize for that. That definitely puts my thoughts, you know, it sort of blows the idea of bringing him in slowly. And so I am open for suggestions from anybody out there in regards to the audit. Franco, do you have any comments since you're chair?
No, I mean, it's just gonna have, it's just gotta work it out.
Yeah. Yeah. Howard, coming back to you. Sorry. What are your thoughts? This is another committee that meets quarterly. Both Franco and Nick have been around on this committee for a while and are very familiar with it. I don't know if there's a heavy workload right now. Franco, is there a heavy workload right now on this committee?
No.
No. Okay. Would you feel comfortable joining? Basically, almost every trustee is on at least 2 committees. That's how it's set up right now. Some are on 3, but they're usually considered alternates. How would you feel about the audit risk?
I'm willing to. Yeah, thank you, Chairman. I'm willing to step in. I think my only consideration would be hopefully the meetings don't overlap or not that close together if they're quarterly, especially.
That is a fair question, Trustee Lee, and in fact, we are communicating within staff right now to check that out. I would suggest, I would recommend the appointment, and then we'll get back to you. And if in fact they are sort of back to back, we just have to check with staff and see how we can, not just for you, but other trustees, to make sure that they are more reasonable, right? Because, for example, if you join the audit risk, you will be there, and so will be, and you in the governance, and so is Trustee Muyo. He will also be an audit and governance. So we'll certainly try to keep that in mind.
Okay. No, I'm fine. Yeah, I think it's all manageable. So I'm fine with that. And the change in plan, Chairman, is fine. That's just the way life is these days.
All right, I appreciate your flexibility and your commitment. So thank you very much. So, all right. Okay, let's go to 4D. Discussion and action on authorizing the secretary to negotiate a tenant release on basically where our office is.
Thank you, Mr. Chair. This is an item that will be presented by Barbara, but I wanted to jump in first to, again, not only thank Barbara for her work on this particular item, but specifically also Dinesh from the investment staff. He was instrumental and doing a lot of the background work and finding options, and so it took a long time. So and work and effort from Dinesh. So thank you, Dinesh, for your hard work, and thank you, Prabhu, for allowing Dinesh to spend the time to go through this process, and Prabhu as well, who was very helpful throughout this process, and very excited to be able to remain in the current building as well, as he has indicated to me in the past. So with that said, I'll turn it over to Barbara.
Thank you. And yeah, I would just like to repeat, really, most of the work was done by Dinesh, and we really appreciate that. So the lease for the building that we are currently in expires in March, and we are requesting the boards approve us to negotiate and execute an agreement with the Pacific Resource First America Limited that owns our current building. A market research was done, and after comparisons were taken, it was decided that really the current building is giving us the best value for money in the area. And we're looking now to have this approved.
And Barbara, I just wanted to probably add that the trustees, they may see some slight construction, obviously once we are away from the COVID-19 virus. So there might be some small changes in the office and also in the 5th floor, but it's nothing major. Is that correct?
That's correct.
All right, thank you. Anybody have any questions? Any trustees have any questions? If none, I'll go ahead and entertain a motion.
So moved. Santos.
Motion by Santos,
Second, Votto.
second by Votto. Any public comments? If not, all right, let's go ahead, roll call vote. Lanza,
Aye.
Eswar,
Aye.
Muyo,
Aye.
Lee,
Aye.
Santos,
Yes.
Sinceri,
Aye.
Votto,
Aye.
and myself, Gardenier, aye. So, so it was just brought to my attention, we do have to go back once again. I apologize to the committee assignments. We did make a motion and approved, changes to the IC. We also need to make a motion and approve the other changes of the audit risk, and we're going to go ahead and put JPC in there. So I'll make a motion to approve the changes to the audit where Eswar will be coming off and Howard Lee will be coming on. That will be the same for governance where Vince is coming off and Howard Lee will be coming on, and JPC where there's a vacancy and Eswar will be coming on. So Gardner will make a motion for approval. Can I get a second?
Second by Lanza.
Santos.
Second by Lanza. Any public comments? All right, Lanza, how do you vote?
Aye.
Menon,
Aye.
Muyo,
Aye.
Lee,
Aye.
Santos,
Yes.
Sinceri,
Aye.
Votto,
Aye.
and myself, Gardenier, aye. All right, apologize about that. All right, so let's move on to 4E, discussion action on fiduciary insurance waiver.
Yes, this particular item, your fiduciary insurance actually expire on March 31st. The reason for the waiver is the fact that in the past, your board has provided staff the ability to sign up for the fiduciary insurance so long as the increase was not more than 5%. We did initiate our process earlier, as we usually do every year, but I think with the COVID-19 and all the challenges, we didn't hear back from the insurance broker on time. And this increase is actually 8.9%, which is actually beyond the 5% threshold that your board had allowed us in the past to sign up the insurance. So we're asking at this time your board to approve this new insurance offer. Before I continue with the comments, Benji, are you there and listening to the meeting?
Yes, I am.
Would you correct me if I'm mistaken? I believe that the reason for the increase is we are one staff, there are two boards, but first of all, we did get other options, but they were more expensive options than what we're offering you right now. And second, some of the increases are related to your sister plan or sibling plan, who is going through a process federated right now on litigation on the 415. So that had an impact on the plans as well. Did I explain that correctly, Benji, or do you have
Yes,
further
you did.
comments?
Yes, you did. Both plans actually increased in premium, and the increase hasn't happened for the past 5 years. This is the first time, or actually, I'm sorry, I take that back. It has increased, but not more than 5%. Last year, the increase was only 1%. So this is really the first time in 5 years that it has increased more than 5%. But they both increased at the same time, but the federated plan is just a little bit more.
Benji, this is Drew. It's interesting. We should put our heads together. We're seeing the same thing on the private side, and I'm not sure why. If every board I'm on is going up a lot this year, even before we had the COVID thing.
Okay, that's what I was thinking too. I think because I did notice that. I mean, even personally with my insurance too.
Yeah, and I don't know if council have any comments, but I know obviously there have been a lot of lawsuits over the last 2 years from plan members, right? Filing lawsuits against the plan sponsor on the defined contribution side of the equation. I'm not speaking about the defined benefit side, but the defined contribution. And I wonder if some of that sort of percolate to the defined benefit side. I'm not sure.
Yeah, it's hard to tell if it is. There has been a spate of litigation on the DC side. The only comment I made, I hadn't heard about the federated increase. We should probably talk about that offline because federated has no exposure in that litigation at all. It's been completely indemnified by the city. So that should not be a reason for an increase in federated's rates. I don't know why they might have increased, but they are increasing across the board to all defined benefit public plans in the state by more than we had seen in the past, but not remarkably more. And it may also have something to do with just competition in the marketplace. I think there are fewer companies writing policies now than there were about 5 years ago.
Okay, understood. Thank you, council. So in any case, we staff recommend you board to approve fiduciary insurance so that we can move ahead and execute the agreement and the contract.
All right, thank you. Does any trustees have any questions?
This is Santos. Will we be making out a check here as soon as we find out what company is going to take over?
Benji?
Yes, it's still going to be the same as last year. We would like a check, but I'm not sure. I'm trying to figure out if we should mail it to the office. I know there are some people that are going in, so we could collect it that way, or do we want to wait until possibly next month when you can hand them to them? But we will need the $75 from each trustee as usual.
So will this be the $75 made out to the city of San Jose?
That's correct.
Thank you.
Thank you, Benji.
All right, thank you. So I'll go ahead and make a motion to approve the fiduciary insurance waiver. Gardenier will.
I'll second it, Santos.
Second by Santos. Any discussion? Public discussion?
So, Mr. Chair, do we just send it in by mail? Is that the best way to do it?
I think what Benji suggested, Trustee Santos, was to wait.
Okay.
We don't always have staff in the office, and when they do, it's very limited. So can we just wait to see if this shelter in place continues? Certainly, we'll reach out to trustees and let you know where to mail the check. Otherwise, if it stops, then we'll pick it up in May when the next board meeting.
Thank you.
Thank you,
Mr. Chairman.
So give us a notice.
Yes.
Yeah, just to avoid confusion, as I understand it, the motion is to approve the next policy terms as presented in the memorandum. Part of that does include the individual trustees' payment for the waiver of recourse against them by the insurance company. But the motion is not just to approve the waiver of recourse portion of the policies, but the entire policies for the premium reported in the memo, I believe. Isn't that what's being requested, Mr. Peña?
That is correct, Council. Thank you for the correction. Yes, you're absolutely right.
Yeah, thank you very much. Yes, that is absolutely 100% correct, and that's was my understanding. So, so we'll go ahead and move forward. The motion by Gardner, second by Santos. There was no public comment. So, Lanza, how do you vote?
Aye.
Menon.
Aye.
Muyo.
Aye.
Lee.
Aye.
Santos.
Yes.
Sinceri.
Aye.
Votto.
Aye.
And myself, Gardner, aye. All right, that motion passes 8-0. Thank you, everybody. All right, we do not have any retirements to report out this time, so we're going to item 5, committee meeting and minutes. I see. I'll actually ask Eswar if he wants to make any comments as a vice chair from last month and now the current chair. Do you have any comments you want to make?
It's just what we discussed as part of the investment discussions today.
All right, sounds good. And our next meeting is May 26th for IC. 51B, we'll go ahead and receive and file the minutes from December 17, 2019. Let's go ahead and go to audit. Votto, is there anything to report out?
Not since the last meeting.
Okay. 5.3, Governments Committee. Muyo, is there anything to report out?
Just briefly, the thing that's been in the works the last several times that the committee has met is the bringing into line the documents between the federated and the police and fire retirement boards, the strategic plans and some various things that they've been working on. So we've been working with Tom Iannucci to do that. My guess is that within the next 1 or 2 meetings of the governance committee, we'll bring it back to the board for a review and approval.
That is correct. Thank you so much, Trustee Muyo. You are absolutely on the money on that one. It was part of this board meeting, but we're trying to limit discussions, even if it doesn't appear that's the case, on the items to be approved by your board. That's why they didn't make it to this meeting, but they'll probably be for the May meeting, if not June at the latest. Thank you.
Yes, sir.
Thank you both for that update. We'll go ahead and receive receive and file the minutes from December 5th, 2019 Governments Committee, and that's 5.3B. 5.4 Disability Committee. Santos, any updates?
As Roberto said, we'll be going to, looks like in May. I think that Drew may have a couple of comments. I think it's, we had a long meeting this last one in terms of causation and different things that Dr. Chairman is looking for. And I think maybe to help to the unions, maybe or for the retirement system, maybe Dr. Chairman can actually write a memo of some type, given different examples or kind of clarifying some of the issues that she's looking at. But she's been, pretty upfront about causation and it has to be related and so on. So go ahead. I'll wait to Drew. He may want to have a comment.
No, I think that's exactly, I don't have anything to add, Dick. I think it's exactly right. You're sort of watching, the board is sort of watching Dick and the committee make a little sausage here, so stay tuned.
So be it. Thank you.
All right, thank you both. 5.5 JPC. Sinceri, is there any comments you have? Feedback?
No, we haven't met for a while. Just looking forward to Trustee Menon joining us on our committee in the future.
All right, thank you. I can't remember, my mind already went back to the disability. I can't remember if I did receive and file the minutes for February 19th, 2020. So if I haven't, I'm gonna go ahead and receive and file 5.4B. All right, no JPC. Is there any proposed agenda items for next month? All right, if there is none, I know Prabhu wanted to make a comment. Prabhu?
Thank you, Mr. Chairman. Just for the record, I wanted to thank especially Officer Jake Kwan. We've made some pretty big portfolio moves, hundreds of millions of dollars. And I was pretty demanding those be executed ASAP, and he rose to the occasion. And we made those on 3 or 4 different dates. And remember that we also have a sister plan, the Federated Plan, which has also made big moves. And he was ably supported by Christina Wang, and the operations people often don't get notice or thanks, but I want to thank Julie on, because you can easily make errors when you make these big moves. And touch wood, we've been able to make all those shifts without any operational errors. That is all, Mr. Chairman. Thank you.
All right, thank you. And I also want to, at this time, acknowledge Linda, Barbara, Michelle, all the other staff. They have worked really hard over the last few weeks trying to get the accessibility to Zoom, to get familiar with it. They conducted several test runs. They set aside yesterday to have a tutorial and familiarization with trustees. And I can't thank them enough for all the effort that they have put forth to make this happen. I was happy with the way the meeting went, using a completely new platform. I thought it was a great success, and it couldn't have happened without them. So thank you very much, all the staff, for everything that you've done. So
it kind of makes you wonder if we have to have meetings not different than this in the future, right? It goes so well.
Yeah. So if there's no other public comments or comments from trustees at this time, I will go ahead and adjourn the meeting till next month.
Stay safe, everyone.
Thank you.
Thank you, everyone.